Good morning, this is Bloomberg Daybreak Europe. I'm Tom Mackenzie in London. These are the stories that set your agenda. Straight to business. President Trump signs dozens of executive orders on his first day in office and flags tariffs for Mexico and Canada. But for now, holding off on China.
We're thinking in terms of 25% on Mexico and Canada because they're allowing vast numbers of people. Canada's a very bad abuser also. Vast numbers of people to come in and fentanyl to come in.
Markets react with the US dollar trading higher while the Mexican peso and Canada's currency sell off. And the new president is the talk of the town, of course, at the World Economic Forum in Davos. We bring you interviews with key leaders from Nomura, Zurich Insurance and Franklin Templeton. Happy Tuesday, everyone. Wrong-footed, whipsaw, take your pick. This is the new name of the game. Volatility for these markets on the policy agenda of this new Trump administration. European stocks currently pointing lower by 0.3, close to 0.4%. Yes, lines on potential tariffs for Mexico and Canada, but nothing concrete yet on the tariff front, and China so far out of the crosshairs so far. We'll see how and when that changes. FTSE 100 futures pointing to the modest losses of about 0.1%. S&P futures, as the US comes back from that holiday yesterday, currently pointed to gains of 0.1%. Nasdaq 100 futures looking lower by 25 points. Let's flip the board and look cross-asset then. You have the dollar up, yields down, and we'll see to what extent that divergence continues. 4.54 right now on the benchmark US 10-year. Yields, Treasuries, I should say, are bid. Yields are down 8 basis points on the benchmark 10-year. The pound in focus, 122 as we lead up to jobs data, 7 a.m. UK time. Wages expected to tick up, but not expected to derail plans for the BOE, at least market expectations that they cut again in February. The pound currently weaker by 0.4%. Brent at $80 a barrel and Bitcoin dropping below that record high of 108,000 yesterday, currently at 101, down 1% on that cryptocurrency. So President Donald Trump says he does plan to enact previously threatened tariffs of as much as 25% on Mexico and Canada as soon as next month. He claims America's two immediate neighbours are allowing the flow of undocumented migrants and drugs into the country.
We're thinking in terms of 25% on Mexico and Canada because they're allowing vast numbers of people. Canada's a very bad abuser also. Vast numbers of people to come in and fentanyl to come in.
When do you think you would enact those?
I think February 1st.
Let's get more with Bloomberg's John Harney. John, the news flow out of this new administration, it's hard to get our hands around, really. It's difficult to know exactly where to start. How does Trump, let's start here, how does Trump 2.0 compare to Trump of 2016 in terms of how we think about the policy going forward and this tone that he set just in the first 24 hours?
Well, certainly the atmosphere right outside is there's some jubilation. Even in the extreme cold of Washington, you have men in dinner jackets and women in gowns going to the parties and balls, etc. The president himself struck a heroic figure, you could probably say. He alluded to the assassination attempt last year and said that he felt that he had been chosen by God to survive, not only survive, and take office again. He spoke of a golden age that he promised to bring forth in this new administration, and talked of his various goals regarding immigration, government overhaul, bringing down inflation, energy policies, and it certainly wasn't a bipartisan speech, but it was fairly magnanimous. Then he went down to another part of the Capitol and went into a diatribe against people like Nancy Pelosi and again railed about his loss in the 2020 election, claiming it had been rigged. And you saw today in those two speeches his aspirations and perhaps wanting to establish a legacy, and the old fixations and resentments that have been a hallmark of the last 4 years.
Talk to us about what we understand about tariffs then, because on one mark, no action on tariffs. Nothing yesterday. But on the other side, of course, he did talk about Canada. He did talk about Mexico, 25%. And he gave a date, potentially February the 1st. How should we understand the tariff policy of Trump?
Well, this all came up during this remarkable session with reporters in the Oval Office as he was signing various executive orders and other actions and answering questions as he went along. And someone did ask him about tariffs, and he said yes on Canada, yes on Mexico. Now, this will certainly complicate, to say the least, trade with the two largest trading partners of the United States, Canada and Mexico. There's a lot of interdependence, and like for instance, the auto industry, which is very much involved in trade with those two countries and the American auto industry, and that would could be bad. It could be face some real problems if these tariffs go forward. But he said that drugs, flow of drugs and migrants has to stop, and real progress has to be made, or else. And the or else could come on in early February.
John Harney, thank you very much indeed on the first 24 hours of this new Trump administration and how we should be thinking, of course, about the tariff threat, as well as all the other executive orders that have been signed off by Trump in just a short amount of time, of course. The dollar bouncing back after posting its deepest drop in 14 months yesterday, amid bets that US President Donald Trump's tariff plans would spur inflation. Let's bring in Bloomberg's Valley Teitel to dive deeper into the latest market reaction to Trump's day one executive orders. And Valerie, I talked about the markets being whiplashed, and the dollar was the channel through which that whiplash came through.
Oh boy, was it a huge pain trade for those dollar longs yesterday. But we are, I guess, glad to see that the dollar is pairing some of those losses in the overnight sessions with big losses in the Mexican peso and the Canadian dollar after that late night tariff threat that Trump gave the markets in his Oval Office speech to reporters just a few hours ago. But let's laser in on this dollar move yesterday, Tom, because we know that those longs, that speculative positioning has been for a long position in the U.S. dollar. It dropped at 1% in a steep move yesterday on reports that we would not get any hard and fast tariff announcements out of the gate. So that pain trade really was there in the market. Thankfully, we have had a bit of a relief rally overnight in the dollar. We also have had a relief rally when it comes to the Treasury market. Again, this lack of any concrete announcements on tariffs has given some room for the Treasury market to rally in relief. We're down 8 basis points in the U.S. 10-year yield.
Yeah, significant moves into the US Treasury market, as you say. Currently yields down and Treasuries are bid 456 right now on the US 10-year, and the dollar is surging up 0.4%. Very Teitel on the market reaction when it comes to the dollar and Treasuries to what we've been hearing from President Trump, of course. Let's get the Asian market reaction. Bring Avril Hong in Singapore. To what extent, Avril, is there relief in the Chinese markets that we have not yet, at least, had any concrete action in terms of Chinese tariffs?
Yeah, I think that's exactly what you're seeing in the equity space, right? The idea that we're not seeing China being targeted specifically on day one. So ultimately, the impact from tariffs could look very different versus if we were to see this aggressive approach on the get-go. So the Chinese stocks are staging a bit of that relief rally, extending gains already that we saw a day ago. Although there are these lingering concerns that after Canada, Mexico, China could be next. So we're seeing the pairing of some of the earlier gains of about well over 1% on the Hang Seng. Tech is the big boost for Chinese equities today. In terms of the rest of the region, it's a pretty mixed picture. We're seeing energy stocks the worst performing as well. Flip the board, let's talk through what we're seeing in the FX really quickly. We are seeing the renminbi looking pretty flat today. Despite the rebound that we see on the greenback, it's interesting to note how EM currencies in Asia, along with the yen, are gaining ground. And of course, for the yen, this is very much about how the traders' expectations are still that the BOJ will hike on Friday. Tom.
Avra Hong in Singapore, looking ahead, of course, to the BOJ and whether or not they have the space to hike again. We know that officials and policymakers there are also looking at Trump actions as part of that determination. Avra Hong in Singapore on the market check in terms of how markets in that region are shaping up in light of what we're seeing so far from this new administration. Thank you. We have a great lineup of guests as well from the World Economic Forum in Davos, of course, this hour. Coming up, Jenny Johnson, CEO of Franklin Templeton, Christopher Willcox, Executive Officer and Head of Wholesale at Nomura Holdings, and Mario Greco, CEO of Zurich Insurance Group. His views, particularly on the costs around the LA fires, will be interesting, as well, of course, of all those executives' views and reactions to what we've seen so far in the first 24 hours of Trump in his second term. Come up. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. The World Economic Forum in Davos is, of course, taking place now in the shadow of Donald Trump's return to the White House. Markets digesting the news that the US president says he is looking at tariffs of around 25% on Canada and Mexico by next month. Bloomberg's Francine Lacroix is there on the ground for us and joins us with another A-class guest. Fran.
Tom, thank you so much. Well, joining us now is Jenny Johnson, Chief Executive of Franklin Templeton, which oversees around $1.7 trillion in assets. And I have to say it's cold. Colder this morning than yesterday, but at least it wakes us up to try and understand and figure out the world economy and everything that goes with it. Jenny, thank you so much for joining us. A lot of the participants here were looking at the inauguration. A lot of the bankers here and the world of finance is expecting deregulation and Donald Trump to not kickstart because the economy is doing okay, but actually better the economy in the U.S.
Well, I think that's right. I think, the view on Trump is that, and he's been very clear, he wants less regulation. I think he said he's going to, for every new one enacted, take away 2 regulations. So I think that's positive for business. I think that he'll continue spending, which, is positive in the short run for our economy. I do think we have a concern with the debt. And, I think he'll extend the tax cuts. So I think people view that as all positive. Obviously, there's a lot of rhetoric around the tariffs. And, the reality is actually, I think 2 things. One is he's a deal maker, right? And if you're a deal maker, the first thing you do is you show your powerful stance. So you make a broad statement, I'm going to tax Canada and Mexico by 25%. Well, and then you sit down at the table, you get them to the table, and you say, this is what I need. I need some help on immigration. I want you to import more of our goods. And so, I think we've seen that that's his kind of approach. He makes big, broad statements. I'm going to buy Greenland. And then from there, goes in with a more kind of practical deal approach.
But is there a danger that actually, if you're a CEO, you don't invest because you're never quite sure what's policy and what's negotiation tactics?
Oh, I think that most people have a clear, I don't know, most people have a clear understanding. I think, you understand under the covers because he makes his statements. In Europe, right, he wants Europe to import more from the U.S. He wants, particularly energy. He wants help on, funding from NATO as far as military funding. He probably wants them to lay off a little bit on the tech companies. I mean, so there's an understanding of what his desire is. And so, then you get to the table and you start to negotiate those things.
I mean, is it impossible to know whether he's better for private markets than public markets?
Well, I don't necessarily. I think I think the view is that he's going to be good for the economy, and that therefore is good for both public and private markets.
What are you seeing in private markets right now?
Look, I think you're starting to see more movement on IPOs, which is good for the private equity business. I think that the areas that I'm most focused on or that I think have tremendous opportunity is secondary private equity. There's just been so much deployed in private equity. There hasn't been that kind of liquidity ability. There's been about $150 billion deployed in secondary PE. And we're still seeing, Lexington Partners raised a fund. They closed a $22.7 billion fund last year. I think they've deployed about 70% of it with very large discounts, almost 60% more than the average discount historically. So secondary PE, we also think real estate debt's really interesting. Banks aren't able to lend. They're clogged up with office. Regional banks were the big real estate lenders. And so as they haven't been able to lean in, those private credit managers who have real estate expertise can fill in that void. And Benefit Street Partners, we have, has about $9 billion in real estate, and they think it's a really interesting opportunity.
Mainly in the U.S., or are there also other parts of the world where you could actually see distress?
Yeah, I think in the secondary PE space, you're seeing it all over because there's a need for, for LPs to get their liquidity. I think in the real estate, that is more of a U.S. issue. Look, I think office all over the world, has issues, but it's B office space, not A office space. But in the U.S., it was the regional banks who were the primary lenders, and they're just not able. Capital requirements have changed in the U.S., and so they're just not able to lend like they used to.
There's also so much talk about, crypto being at the center of the Trump administration's kind of second mandate.
Did you participate in the Trump and Melania meme coin or whatever it is?
I haven't, but this has everyone excited. They were even talking about it in Davos. Does it change appetite for ETFs? Does it change, the market liquidity in some places, and does it impact basically your company?
First of all, I think it's really important to think of blockchain as a technology, as a programming language, right? That does certain things really well. I do think that it's likely that ETFs and mutual funds will ultimately be built on blockchain just because it's an incredibly efficient technology. And then there's the crypto world, some of which I think has tremendous opportunity, and some of which I think it'll be noise. It'll be a little bit like the dot-com era when, eventually you had some of the biggest companies of the next decade that came out of it, and then you had a lot that kind of blew away to the side. And so I think the crypto world is similar. I think the thing with the Trump administration is we're going to start to see them converge more, the TradFi and the crypto, which is something that we need. We need to have some sort of regulatory clarity so that you can bring these together, because fundamentally it will drive out costs, and there is great innovation that the technology enables.
But is that going to be overlaid by inflation?
Well, so in inflation, I do think that if I were to predict, I think that you could have at the end of 25, the 10-year at 5%. And by the way, from 1950 to the GFC, kind of the neutral rate on Fed funds was about 4%, and the 10-year was 5%. That's actually much more normalized. I think that's what we're going to see. And I think that the Fed is going to pause right now. They're going to try to, this gives them time to see how Trump's policies impact the economy. Some of them can be inflationary. And let's face it, the U.S. consumer is still very strong. The inflation numbers, unemployment's still pretty low. So the inflation numbers are pretty sticky. And I just don't know that we go back to that period of much lower interest rates.
But that, again, changes everything, which is maybe why you're seeing opportunities, probably, if you're higher for longer.
So, but kind of more normal for longer, right? It's much more of a normal rate. And I do think that, for example, on the private equity side and private market side, look, it was easier to make money when cash costs nothing. Now you have to be very skilled because your carry cost of, say, 5 to 8% means that your investments are going to have a drag on them, and so you have to be very good. And so I think you'll see those who are skilled, and others will fall away.
Jenny, for the integration of Western, how's it going? I know you've started with some big chunks of it.
we are working through the integration of Western, yes. And that we've done it. I think now when we bought Legg Mason, it was actually like buying 7 managers. Plus we've been integrating Putnam Investments, and then there's less integration that happens on a private market acquisition than a traditional acquisition. And so we've been methodically going along, and so we're in that process.
And so it's going to plan? Is it quicker than expected, slower?
It's probably quicker than expected because we were not planning to do it until after July 25, and now we've started that process earlier.
And are you happy with the progress so far? I mean, you started earlier. Will it finish earlier? And is that a positive for your clients?
I think it's definitely a positive. I mean, look, our whole model is to keep the investment teams independent. and to build scale around them. And it's become even more important. Actually, one of the acquisitions, it was actually our private credit manager said, when Franklin bought us, we thought they'd help us on distribution. But now that I see what's happening on AI and the cost of data, I realize we could never participate at this level without the kind of scale and breadth of Franklin Templeton. And so that's what we try to build at the center and then leave the independence of the investment teams.
And I know, Jane, there's been an issue, of course, with one of the managers there. Any update?
We are still working through it,
Okay, Jenny Johnson, thank you so much for joining us. The first Davos, actually.
We
have to catch up at the end of the week to see how's it been going so far. Fun?
So far, it's great. It's good to be here.
There you go, Jenny Johnson, Chief Executive Officer, of course, of Franklin Templeton. With that, Tom, I'm going to send it back to you, and we'll have plenty more from Davos. It feels like day 6, but it's actually only day 2.
Okay, stay warm. Great conversation. Bloomberg's Francine Larka, thank you very much indeed at the World Economic Forum in Davos. Plenty more, of course, coming up with and from Fran and the rest of the team through the next few hours. Our Davos conversations continue this hour. Christopher Willcox, Executive Officer and Head of Wholesale at Nomura Holdings, joining us at 6:30 a.m. London time, so in about 8 minutes' time, to discuss the outlook for deal making. And at 6:40, we're going to speak with one of Europe's largest insurers, Mario Greco, CEO of Zurich Insurance, of course, joining us on the state of the insurance industry. Do not miss those conversations. Lots more coming up. Stay with us. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. We have some breaking news crossed in the last couple of minutes. Could create one of the biggest asset managers in Europe. This is a potential tie-up between Generali and Natixis. Natixis, of course, part of the banking group BCPE. This is looking at a 50-50 joint venture. The lines crossing then. Generali and BPCE, again, the parent group that includes Natixis within that grouping, signing a non-binding deal for asset management JV. So the details are this. They're close to a deal in terms of a joint venture in asset management to cut costs and team up on distribution. It will be owned equally by the two companies. So we'll keep across this story for you. We'll watch the stocks, of course, at the open, 8 a.m. UK time. Generali in focus. Could be in the process of creating one of the largest asset managers in Europe if they get this deal across the line. Now, some other stories making the news this Tuesday. Veteran Republican Senator Marco Rubio has been confirmed as Donald Trump's Secretary of State, the first of the US president's second-term nominees to be approved. Rubio, who served 14 years on the Senate Foreign Relations Committee, is one of Trump's more conventional cabinet choices. He was cleared by a vote of 99-0 in the Senate, in a sign of the broad support he has among former colleagues. President Trump, meanwhile, has ordered the US out of the Paris Climate Agreement for the second time. The withdrawal will take a year to go into effect, but signals Trump's commitments to rapidly overhauling US energy and climate policy. The spectre of the world's second biggest polluter leaving the accord, again, has already shaken global climate diplomacy. Orsted has recorded a $1.7 billion hit on its earnings as the costs of offshore wind farms, especially in the US, keep rising. The setback is the latest in a long series of issues for the Danish company, one of the world's biggest developers of wind farms at sea. It comes as the industry faces up to President Trump's vow to immediately stop leasing areas for new projects. Coming up, our Davos conversations continue this hour. Christopher Willcox, in fact, not Chris Waller, the Fed member, but Christopher Willcox, the Executive Officer and Head of Wholesale at Nomura Holdings, will join us shortly. Stay with us. This is... Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. Happy Tuesday. These are the stories that set your agenda. Straight to business. President Trump signs dozens of executive orders on his first day in office and flags tariffs for Mexico and Canada. But for now, holds off on China.
We're thinking in terms of 25% on Mexico and Canada because they're allowing vast numbers of people. Canada's a very bad abuser also. Vast numbers of people to come in and fentanyl to come in.
Markets react. The dollar trading higher while Mexico's peso and Canada's currency sell off. And the new president is the talk of the town at the World Economic Forum in Davos. We bring you interviews and reaction. Key leaders from OpenAI, Nomura and Zurich Insurance over the next few hours. The markets then. Strap yourself in, hold on to your hats, brace for volatility, whichever one you reach for. This is, it seems, the new setup for the next few days, for the next few weeks, possibly for the next 4 years. This is how it unfolds. European stocks currently pointing lower by 0.4%. The question marks and the uncertainty around tariffs continues. FTSE 100 futures currently flat. S&P futures, as the US looks to return from that holiday, currently pointing up by 0.1%. Nasdaq 100 futures pointing to gains of 27 points. Let's flip the board and have a look at what's happening in terms of treasuries. Bid with yields down, price up, despite the fact that we have stronger dollar in the session. 4.55 right now on the US benchmark 10-year with yields down 8 basis points. The pound at 122, down 0.4%. Wage data, labour data out at 7 a.m. UK time. Ray Dalio of Bridgewater telling the FT that the UK could be heading for a debt death spiral. The warning there from Ray Dalio. Brent currently trading just below $80 a barrel, down 0.3%, and Bitcoin having punched through 108,000 at a fresh record, falling currently at 101, down 0.8%. Now, M&A bankers got back on their feet in 2024 with global transaction values up 16% to more than $3 trillion. They are now waiting to see whether a second Donald Trump presidency will turbocharge or temper their emerging recovery. Let's get more with Bloomberg's Linda Armin in Davos.
Hey, Tom, it is about reading the Trump tea leaves 24 hours on what will it mean for markets. What will it mean for deals? Well, let's get perspective, insights from Christopher Willcox, Executive Officer and Head of Wholesale Banking at Nomura. Good morning.
Morning.
So how are you assessing, tariffs for Canada, Mexico, not yet for China, dollar higher or lower? How are you reading all of this?
So look, I think the thing that surprised us initially was we didn't hear anything about tariffs, and now we've heard the story on Mexico and Canada. So one of the things it says is that Trump seems to be focused close to home, but I'm sure we're going to see further tariff conversations later on. I think for us, there are two aspects of the Trump agenda as we assess it. The first is tariffs, which is what everybody's talked about, and the second is supply-side measures and efficiency measures and government spending efficiencies, DOGE, etc. Our assessment's always been that tariffs will come quicker and have a quicker impact, and then that supply-side measures are going to be slower and harder for him to implement. So really is the trade-off between those two things.
Well, the key question is whether all those measures will be inflationary. Will the Fed have to reassess its moves, inflationary or not?
So I think the broad consensus is that tariffs have an inflationary effect, and then the supply-side measures can offset that. So our view would be that probably the policies will be inflationary in the first year, and then if the administration is successful in some of the supply-side measures, that might start to offset over time. Having said that, just intellectually, tariffs don't have to be inflationary. If the tariff increases are matched by an appreciation of the dollar, that can offset the inflationary impact.
And what that means for deal making. We just had Tom pointing out that it had a fantastic year. Will that continue? What kind of pace? What are you seeing?
Well, I think the environment for deals looks pretty good. I think broadly you see an optimistic outlook. It's been a good year this year, big recovery. It's been a particularly good year in Japan, where there's obviously a lot of structural changes going on in the economy. And I think that in the sort of more business-friendly environment and probably with less regulatory interference in mergers, we will probably see a pretty healthy deal environment, yeah.
And speaking of Japan, of course, the big question is about the BOJ. Expectations are it will raise rates on Friday. Of course, we've been expecting this again and again. We have been disappointed, but it's kind of in the bag this time, isn't it?
We think it is. I mean, obviously, the BOJ will have been watching the inauguration carefully, and in case there's something very disruptive from it. But I don't think there's anything in it that would necessarily make them stop. So we do expect them to go 25 on Friday. After that, we think BOJ is going to continue to raise, but it's going to be very slow, very cautious. The policy that they've had in place has been in place for a very long time. They're cautious about disrupting the markets. When they first started raising rates, there was a pretty big market impact. So I think we're going to see the very slow but steady and cautious approach. But yes, we think rates will go up, and we see a terminal rate of around about 1%.
You talked about how it impacted the market the first time it raised rates. We talked about how stocks got dumped, down 12%, and the yen carry trade was unwound. How do you see the rate rise that you're expecting on Friday to play out in the market then?
Well, I think with all these things, the first move is usually the most disruptive, right? So I don't think we're going to see the same sort of disruption we saw before. We think probably there's some room for dollar yen to strengthen, for the yen to strengthen, I mean. And over time, our forecast is for dollar yen to come down towards the 145, 140 range based upon narrowing interest rate differentials. But I would say our view on that, which was quite strong last year, we're probably more cautious. There's more risk to the view than
is it 140 or 145? Your last estimate was 140.
So I think our year-end forecast is 140, and obviously a stop on the way to 140 is 145. Like I said, I think our level of conviction on the call is we still believe it, but there's more risks to it right now, as there are probably more risks to every macro view in the market in the current environment.
Given all the assumptions that you're making and that macro view, how do you position? How do you position for 2025?
So broadly, I think obviously we're bullish on Japan markets. So we still think there's a lot of upside there. Even though the equity markets come a long way, it's still sort of 15, 16 times earnings. So cheaper than many other markets. In terms of FX, broadly speaking, I would say that we have a strong dollar view. We have a stronger yen view. One of our forecast views is to be long yen against the Swiss. And in terms of the dollar, broadly, we see the dollar appreciating against Europe because we see interest rate differentials moving in different directions. We see a lot more caution from the Fed over the next year, probably less interest rate cuts than were being priced in until fairly recently. But we still see rates being cut in Europe and India and possibly China.
Christopher, before we let you go, China, is it a buy or not? I mean, it escaped the tariffs this time around, but some say it is coming. It's just a matter of how much. Is China doing enough to reverse sentiment and confidence?
So last year, we strongly viewed that China was going to have to engage in stimulus, which it was saying that it wouldn't. It did eventually do the stimulus. I think the stimulus had an effect. We saw the impact on the markets. It's probably not enough. There's still a major real estate market overhang there that's going to have to be cleared up. So our expectation is that China, the currency is probably going to depreciate somewhat, and that the government's probably going to have to do renewed stimulus. One of the unique aspects, obviously, of China is also that the real estate problems reflect also into local government finances as well. So there's a number of structural issues that the Chinese government's going to have to approach. We think probably this year we will see real action from them, and depending on how aggressive the action is, then you can get more confident.
So we've seen the floor then, right?
I would never say that you've seen the floor in anything. I've been around for too long.
Not even in China?
No, not even in China.
All right, Christopher Willcox, we thank you so much for that. Christopher Willcox, Executive Officer and Head of Wholesale at Nomura Holdings. Tom, I think volatility is the word for 2025. Brace, brace, my friend.
Brace, brace, yeah, hard to avoid that, isn't it? No determined floor around China as well. Not putting a line under that, at least for now. Great conversation. Bloomberg's has Linda Armin on the ground for us at Davos, at the World Economic Forum, of course, and we have plenty more great interviews coming from that forum in the next few hours. We're going to be speaking with Europe's largest insurer, Mario Greco, one of Europe's largest insurers, of course, the CEO of Zurich Insurance, joining us on the state of the industry. That is coming up next. This is Bloomberg. Welcome back. The latest global risks report by the World Economic Forum cites extreme weather events among the top risks this year. In Los Angeles, of course, the cost of destruction from the fires is likely to be in the tens of billions of dollars, with many homeowners facing an insurance crisis. Bloomberg's Francine Lacqua is on the ground in Davos, joins us now with a guest who can talk to that story and other parts of the insurance industry. Fran.
Yeah, Tom, thank you so much. We're here to talk economy and insurance. Joining us is Mario Greco. He's the Chief Executive Officer of Zurich Insurance Group, one of Europe's largest insurers. Mario, thank you so much, as always, for giving Bloomberg a little bit of your time. We'll talk a little bit about the LA fires in a second, but when you look at your industry in 2025, what do you think it will mean for it? We could see deregulation in the U.S. Will Europe have to play catch-up?
Has to, and hopefully will wake up and do it. Because U.S. is moving, as we saw last night. Asia continues to thrive and grow. And so Europe is the beauty asleep and has to wake up.
In terms of what, competitiveness, in terms of regulation, like what's the right way to look at European business and say, look, if you don't want to be left behind, this is what you do? Investments.
Europe is well behind U.S. and China, investing in new technology, in AI, in digital. Dynamism, and the world is changing, and corporations are changing too. Europe is not, and has to move quickly towards that. And then integration. I mean, Europe is not one market. So this is, of course, I mean, will we ever see in our lifetime some integration in terms of capital markets union, or that would also help insurance move places around? I still have hopes. Okay, that doesn't sound very optimistic. What do you think needs to be done for that? Will Trump in the White House wake Euro up, or does it have to be something deeper? Yeah, Europe usually reacts at the last minute. When it is back to the wall, it acts. Yeah. We're pretty much there, and so I'm really hopeful now that actions will be taken. And the reports that came out at the end of last year from Letta and Draghi, they all pointed in the same direction. Action is needed. This is the time. Do it. Mario, I mean, the LA fires were really quite shocking to see. Of course, when you look at the images, how much does it cost Zurich? To Zurich, honestly, not much. Zurich is not that present in California for individuals. To farmers, this is an event. But farmers was prepared for this. Farmers has seen this kind of events before. Is helping customers, is acting, and especially what farmers has been doing there in California together with the government is trying to prevent and mitigate these kind of actions. More needs to be done, because these are repeated events, and they are dramatic, they're terrifying, and they should not happen again. Do you think operations will change because of that, and in what way? I think the way the cities are structured, and Los Angeles especially, must be rethought. The way it is built there, the way people are protected and defended against these events must be completely rethought and replanned. And hopefully this time the message has been strong enough that they're going to act on this. Mario, for your industry worldwide, what do you see as most transformational in the next 12 to 24 months? I think the level of risks are raised. And frankly speaking, this calls for companies which have a strong balance sheet, which have strong skills, and which invest heavily. I mean, everything we do today is data-driven and is based on technology, and it's connected. Not all companies can do that. I would say not many companies can do that, and this is, frankly, the way forward for us to continue doing this. So, I mean, is there any doubt in your mind that we're not going to see more climate-related events that will, of course, cost the industry more billions? We will. We will, because also we have built the society in a very tight way. The agglomeration in the big cities calls for these events. There has been massive destruction of rivers, reservoirs of water, and this has consequences. But we can fix these things if we act now and if we act quickly.
So, Mario, what does it mean for Zurich in terms of how you want to go forward and grow?
We're not shy of taking these risks, and we're not shy of helping the customers. A lot of what we're doing is about prevention. So we help the customers avoiding finding themselves in these situations. I mean, we don't like to come just with a check when the damage happened, because this is never satisfactory. You have to avoid these things from happening.
Very quick, I mean, does AI really help in that, in predicting either weather patterns or helping clients?
It does, yes, it does. Technology helps a lot, helps us, helps the customers. Now also governments, institutions have to understand how to use it and how to hear and listen to the messages, but it does.
Mario, thank you so much for joining us today. That was Mario Greco, the Chief Executive Officer of Zurich Insurance Group. And of course, Tom, I'll send it back to you in London. We'll have plenty more from the World Economic Forum.
OK, Francine Lacroix, of course, on the ground for us at Davos, at the World Economic Forum in Davos. Fran, another great conversation. Thank you. And as Fran was saying, plenty more coming up through the next few hours and through this week. Some other stories making the news this Tuesday. Staying in Davos, UK Chancellor Rachel Reeves will meet with the CEOs of JP Morgan and Goldman Sachs, Jamie Dimon and David Solomon. Reeves is hoping to persuade company bosses to invest in the UK amid flatlining GDP and persistent inflation. Staying with the UK, and Bloomberg has learnt that the government is preparing to approve expansions to 3 London airports as part of that push to spur growth. The plans include a 3rd runway at Heathrow, increased capacity at Gatwick and expansion at Luton. The proposals are part of a wider push to advance long-delayed planning decisions and infrastructure projects. European car sales barely grew last year as persistent inflation, higher borrowing costs and apathy towards electric models led consumers to hold off on buying vehicles. According to the European Auto Manufacturers Association, car sales grew only 0.9%, while sales of fully electric vehicles fell 1.3% after countries including Germany ended subsidies. Automakers face a perfect storm this year thanks to stricter EU emissions targets, tariff risks and lacklustre demand. Apple's iPhone sales, meanwhile, in China dropped 18.2% during the December quarter, a major setback for the company in its biggest market after the US. According to Counterpoint Research, Huawei surpassed Apple as the top seller in China with a 15.5% year-over-year sales increase driven by new device launches. The drop in iPhone sales in China has been put down to the lack of new AI features as Apple seeks a local partner to provide AI infrastructure. There's plenty more coming up. We're going to give you a preview of the jobs data set to come out of the UK in about 9 minutes' time and give you a check on the US dollar that has been reacting to tariff speculation from Trump. Stay with us. This is Bloomberg.
Essentially, with TikTok, I have the right to either sell it or close it. And we'll make that determination. And we may have to get an approval from China, too. I'm not sure. But I'm sure they'll approve it. I think you have a lot of people that would be interested in TikTok with the United States as a partner. We're thinking in terms of 25% on Mexico and Canada because they're allowing vast numbers of people. Canada's a very bad abuser also. Vast numbers of people to come in and fentanyl to come in.
When do you think you would enact those?
I think February 1st. China charges us tariffs, and we charge them very little, except for what I did. I put a lot of, we took in hundreds of billions of dollars. But until I came along, China never paid 10 cents to this country. I'm fine with legal immigration. I like it. We need people, and I'm absolutely fine with it. We want to have it. We need it because we're going to have a lot of companies coming in to avoid tariffs. We're the only country in the world that does this with birthright, as you know. And it's just absolutely ridiculous. But, you know, we'll see. We think we have very good grounds.
Okay, some of President Trump's executive orders that he signed following his inauguration in comments to the press who were gathered, of course, in the Oval Office during some of that signing ceremony. The clearest and cleanest reaction function and gauge to some of the volatility and the concerns around tariffs comes through in the FX space and, of course, the primacy of the dollar. And this is the roller coaster ride that it's been on in the last 24 hours. You had this big drop when it became clear that tariffs and action on tariffs was not going to be part of the decision-making of Trump in the first 24 hours. And then you had the spike up again, pairing some of the losses on the comments around Canada and Mexico and the potential 25% that he said February 1st could come through. So just continue to watch the dollar as that reaction function, the volatility, of course, in terms of the concerns as markets and traders try to understand what is in play in terms of the tariff agenda for Trump. Let's flip the board and have a look at what to expect from the data out of the UK in just a couple of minutes' time. It's the focus on wages. It's the focus on the unemployment rate. You're expecting to see unemployment tick up possibly to around 4.4% from 4.3%. Wages, though, is arguably the most important component. Expected to tick up wages to around 5.7%. Bloomberg Economics says this will not derail the next cut from the BOE. Expected by many traders now, more than 80% chance coming through in February. And of course, there is the messiness and the lack of clarity around the jobs data and the labour survey of the UK to take into account. Bloomberg Economics says some of the alternative data suggest a clear cooling in that labour market. Let's flip the one and have a look at the earnings story when it comes to Netflix. And expectations, you could get a margin. You could be looking at margins of close to 30%. That's the view from Bloomberg Intelligence. Revenues could be coming in above $10 billion US. The earnings dropping later, of course. The subscription rate will be in focus. The new content, you've got Squid Game, the second series coming through. To what extent is that going to lift the numbers coming through from Netflix? On the earnings front, that's in focus for us today, and we'll be breaking that down for you. But of course, primarily and in focus for us over the next few hours is reacting to, of course, the flurry of measures coming through from Trump. And we continue that analysis and the interviews coming up. The opening trade is up next. This is Bloomberg.